All right, guys, we have an amazing guest on the show today, Matt Tuttle. Been in the industry since 91, been running ETFs and launching them since 2015. And I'm going to describe Matt as an old school businessman. And what I mean by that is it just seems like he looks for opportunities wherever they are. So Matt is himself a retail trader. He builds ETFs with retail traders in mind. So Matt, with that, going through a massive change in what's going on in DC right now that has huge impacts on the market, let me just broaden this out and say, how are you seeing things? Do you see opportunities? Where are they in the market right now?
I see opportunities all over the place. It is a target-rich environment right now. We were talking before this. I'm an active trader myself. I have never held this many positions personally because I cannot cut my watch list down, and they keep coming. So, like one, for example, is AI in healthcare. I knew that was going to be big. I mean, Jensen Huang came out, I don't remember when, 6 months, a year, something like that, and said, hey, AI in healthcare is going to be big. If Jensen Huang tells you something's going to be big, it's going to be big. I assumed it was going to be a ways out. Yesterday, over the weekend, news came out that Nancy Pelosi bought Tempest AI, which is an AI healthcare company. Nancy Pelosi, when she buys a company that, I mean, luckily I owned it. It was up 40%. It's great. When Nancy buys one of your stocks, that's awesome. But when Nancy Pelosi buys a stock that not most people have heard of, that's interesting. Then you have the Starlink announcement last night, and all Larry Ellison talked about related to AI was healthcare. Yeah. So, that's one area that went from very low on my radar screen to I need to be in more of these names. The whole AI infrastructure is getting more interesting. You've got drones, you've got crypto, on and on and on. There are opportunities everywhere right now.
What do you make of the back end of this declaration of energy emergency that Trump is putting out in the market right now? It seems to me almost that he's taking or wants to take EV credits away on one side. He wants to have less build out of EV charging stations. And on the other side, he's funneling that energy saved potentially from this side, as I see it, to AI and us building that out more quickly. And I just see it as Trump making the decision that the focal point for us is AI. It's not EV. That's what's going to progress us into the future. Is there any logic to that? It's my own personal thought.
So there's a lot of stuff going on there. So first off, to make AI really work, we don't currently have the infrastructure or the power for it.
Correct.
Which also means we're going to need all of the above. So we're going to need solar. We're going to need wind. We're going to need all that stuff. We're also going to need coal. We don't have enough to do what we need to do, and we're going to have the infrastructures. I see the EV as something separate where, I think that is a couple of things. Number one, giving people choice. If you want an EV, you can buy an EV. If you don't want an EV, you don't have to. And I think, a handout to U.S. auto workers who are maybe, feeling the pinch that, an EV mandate may ship some of those jobs overseas.
Yep.
So, and then, the whole thing about drill, baby, drill is more of an inflation type of thing than anything else because oil prices impact everything. And one easy way to bring inflation down, you bring oil prices down, that brings a lot of different things down. So there is so much going on right now in energy, in all areas of energy, nuclear, oil, natural gas, coal, and all the renewable stuff as well.
Yeah, we see the big opportunity in nat gas. I think that's the easiest.
Nat gas is the today.
Yep.
What's going on. Nuclear, and I own all the nuclear stocks. Nuclear is a few years away. What I've been spending more time on is the infrastructure on nuclear. Because, nuclear may be 5 or 10 years away, but you've got to build the plant. Who's
Yeah.
building the plant? Who's
Yep.
providing the materials? Who's going to make money on that? And interestingly, how I like to trade is I use AI. So I'll tell AI, hey, nuclear may be 5 or 10 years away. What companies are getting the contracts to build it? And then I'll go and buy those companies.
Yeah. What's interesting is nuclear got a black eye, and the black eye was in Georgia. It cost $30 billion to build that nuclear facility, and it took 10 years over what was budgeted. It was $10 billion and 10 years over budgeted. Do you think that experience works out the kinks? Do you think it continues to be large scale nuclear like that, or does it come down to a smaller scale?
I think what we're looking at is people are going to try the small, the SMRs.
Modular reactors, right?
Yeah, I think that's where people are going to try to go. Whether that's going to be enough for the demand. And I mean, I am not an energy expert. I talk to energy experts who say, whatever they say it's going to be, 100x it, because we're going to need 100 more than they're saying. So you see an article saying we're going to need X, yeah, just times that by 100 and maybe you're there. So I think there is going to be such an insatiable demand for power. You really are going to need to have everything. And from an investment standpoint, I think you've got to be there in all of it, because you just don't know. And these announcements just come out fast and furious. I mean, Constellation Energy is a company, luckily I'm there. And, the other day they made an announcement, they're up 25%.
Yep.
I mean, did I know that was coming? No. But, if I wasn't there, once it's already up 25%, you're too late.
Yeah. And so you do something different than us. We are a traditional wealth manager, and it's not just the opportunity in infrastructure. It's when you look at a portfolio and constructing a totality of a portfolio, what infrastructure does is just acts so differently historically to traditional stocks and bonds. So not only do you have the insatiable demand on that infrastructure to build out energy to power AI, but also how it diversifies the portfolio, in a time of inflationary pressure. A lot of times energy what causes inflationary pressures. These infrastructure contracts often have inflation riders in them. So that offsets that. When your bonds are getting eviscerated by inflation, you have infrastructure there backing that. And then on the other side, when you see massive sell-offs in the stock market, traditionally, even on the equity side of infrastructure, it's held up phenomenally well. So, from a retail trader perspective, obviously there's opportunity right here and now for going out and finding opportunity and upside, but the portfolio construction aspect of it can't be underwhelmed on the other side. It's hugely important.
Keep an eye on your correlations, because I don't know this is going to happen, but you do see it kind of day to day as everything starts getting correlated to AI. So Apple and Constellation Energy are two totally different things.
Yeah.
But if they all become correlated under this AI theme, then they all may start moving together. And you do see days, because, I've got personally, I've got, the AI, I've got first order, second order, third order, fourth order AI companies in my portfolio,
right,
which are in totally different industries, but you have days where they're all down or they're all up.
Yep.
One day is not a trend, but I could see that stuff starting to correlate.
Yeah, totally. And we buy that on the private side, which strips away a lot of that correlation in general. So that's certainly helpful. Let's talk about, you've got $3.9 billion under management inside your ETF umbrella. Talk about when you launch a new ETF, what makes yours different? What makes you see the opportunity, and how is it you bring that to market?
Yeah, so I think, again, we talked about the fact I'm a trader. I think that sets me apart. Because I want to develop products that I'd want to trade myself. Yeah. And 99% of the ETFs out there, I would not touch with a 10-foot pole.
Right.
I think they are, poorly designed and or marketing gimmicks. Yep. So I want to design something that's like, hey, I would buy this. So I'm looking at a couple of different areas that interest me. number one is tools for self-directed traders. What can we design for these guys? Number two is because I'm a thematic investor. Yeah, and I spend a lot of time on themes and looking at, again, first order, second order, third order. What are themes that are under the radar screen that I want to invest in, and I think other people should want to invest in, and we're going to launch those. I'm always tapped into the news cycle, and again, I use AI. Like, I'll see a story, I'll throw it into ChatGPT and say, hey, give me the implications of this. Who are the winners? Who are the losers? And if I like what I see, I mean, maybe that's a theme, and maybe that's a durable enough theme that's ETF-able.
Yep.
My big thing for 2025, there's been a whole bunch of covered call ETFs that have been issued. Totally. As a trader, I am not a fan of covered calls. I think there are way better ways to generate income. So we're going to be launching some of those.
So talk to me because covered calls is a hot button. JEPI from JP Morgan was launched in 2022, covered call strategy. The thesis behind all of them is they're income generative, and what they're going to do is strip out some of the downside risk. But inevitably, if you're stripping out downside risk, what you're doing when you write a call and the stock goes up is you're giving up upside because it's getting called away. I'd imagine that's the downside, but let me.
So yeah, a couple of things. So in when we were talking before, I told you we teach people something I call the heat formula, which is hedges, edges, asymmetry, and themes. Asymmetry is big for me. I think if you're a trader, your trade should be asymmetrical returns. Heads, I win a lot. Tails, I lose a little. Your portfolio should also be designed for asymmetrical returns. Heads, I win a lot. Tails, I lose a little. Covered call strategies are heads, I win a little. Tails, I lose a lot. The downside protection is only the premium.
It's only income, right?
If I sell a Tesla call for $3, great. All right, I put $3 in my pocket. If Tesla goes down $3, I don't lose any money. Tesla goes down $6, $10, $20, $100. I'm as screwed as everybody else.
Yep, minus 3% or whatever the premium is, which you're still screwed.
And if Tesla zooms up, I give up a huge chunk of my upside, and then I'm doing a balancing act. Do I put my strike price right near and get a great income? Do I put it away, get not much income and very little downside protection? Right. I don't think those are good products. I am a much bigger fan, apples to apples, of cash secured puts.
Okay.
So and I've had ChatGPT look at this for me. Hey, am I missing something? Apples to apples, cash secured puts will give you a better yield and will give you much less downside. And, so to me, I am a much bigger fan of cash secured puts. The other thing I like zero DTE, because in a zero DTE covered call strategy, I'm not giving up my overnight returns, which is where most returns come from. So like if you've got a weekly call option on MicroStrategy, and MicroStrategy opens up 15%, which it has a tendency to do, chances are my call is in the money. But if I'm doing zero DTE, I wake up, I'm up 15%, and then I put a call up 25%. Yep. And I get the best of both worlds. I'm getting income and I'm getting the appreciation.
Interesting. Yeah. Yeah. When the overnight market, when MicroStrategy tracks a Bitcoin, which has, overnight markets, it creates an inefficient strategy there. So you made a comment in the green room that I was just fascinated by. You made two comments. I'll get you on both of them here. So you said indexing is dead. Now, this is something that's interesting because if you want to talk about one theme in the market over the past 15 years, you got it right there, indexing. And there's a lot of folks now that are bringing up concentration risk. Top 10 names are nearly 40% of the S&P 500. What is your gripe with indexing?
So, and there's two things there. So indexing from a sector and a thematic standpoint is obsolete. And you look at some of these index funds, and they don't make a whole lot of sense. Why I say they're obsolete is because of what AI can do. Okay. So what AI can do is, and in a couple years ago, I sat through a presentation of something called direct indexing, which when I saw it, I thought, wow, this is the future. I can customize indexes. Then I started playing around with ChatGPT. I was like, this is light years ahead. So ChatGPT, I can ask it, who has the most exposure? Who are the winners? Who are the losers? Weight me a portfolio. I can do things that a dumb index is not going to be able to do. So I just think when you're looking at sectors and themes, AI can construct a portfolio that's light years ahead of what's out there. When you go to the, sorry, what's that?
What do you say to someone that would say, you're overly dependent upon AI, which is dependent upon every input in the internet that can be, biased towards whatever's getting the most views?
So I think, yes, I have become overly dependent on AI. I use it every day in my trading. I mean, it makes me money. I mean, I'll give you a great example. California wildfires are in the news. I throw in AI, who are the winners, who are the losers? Gives me a list of winners, companies I'd never heard of before.
Okay.
I bought calls on them, doubled my money on all of them. Gave me a loser that I'd never heard of before. Bought puts on it, made a bunch of money on that. Money I never would have made because I have no idea what these companies are. I don't know who's going to get the contracts to rebuild California. ChatGPT does. Is
there further research into it than that, or is it no?
Okay. So I mean, I keep going down. Like I think the only alpha left, hold on, in this market is AI, but it's not just, hey, I'm just going to throw something. You've got to know how to prompt. You've got to know how to get step by step. And to your point, you've got to have some knowledge where, sometimes it'll spit something out and be like, you're wrong. What about this, this, and this? The cool thing about it is you know what, Matt, sorry. Yep, you're right. Or, I'll ask it for a list of names. It's like, how'd you leave out Google? Right. And oh, sorry. Yep, you're right. Google. Yep, it's an 8. Okay. Who else did you leave out? Oh, we left that. All right. Thank you. So it's, I mean, it's not easy. You've got to learn how to use it. You've got to learn how to prompt. But if you look, today, where's the alpha? When I first got into the industry, I was told, diversification, asset allocation is the only free lunch on Wall Street. Mm-hmm. Look at the returns of everything, whatever you want, international, value, emerging market, bonds versus the S&P 500. Mm-hmm. Adding any of those things into your portfolio did not help you. It hurt you. And I'm not saying you should be 100% S&P 500. I'm just saying asset allocation doesn't work.
And what would you say to the pushback on that of these trends have played out over time and there's a reversion back to the mean?
I think that things are different. And could there be a reversion back to the mean? Maybe. But do you want to keep beating your head, against the wall? And, and sometimes things work. But like, to the person who's, bonds are a risk reducer. Okay, sometimes, but look at 2022.
Oh, they got smoked. Bloodbath.
And when stocks were getting smoked. Correct. So, your bonds didn't help you. I just think you want to look for a better way. And
so how do you mitigate risk then? If you have $100, $1 million, $100 million, what percentage of that are you deploying? And how are you mitigating the risk on the downside?
All right. So we're getting a little complicated. So
I knew that was going to be in the weeds.
Yeah. Cut me off if you want to. So I am an options guy. Mm-hmm. And most of the time people are, oh my God, options are so risky because most people who buy options lose money. So I do not disagree. Options are a tool. Depends how you use them. So my portfolio is approximately 80% T-bills and 20% options. So if you just look at that from forgetting that I also own some puts, let's say we enter a October 2007 to March 2009 environment where the S&P was down 60%.
Yep.
With my portfolio, worst case scenario, let's assume my T-bills are nothing, which they're earning 4 to 5%, but just to keep the math easy, and every single one of my options goes to zero.
Yep.
I lose 20%. So I lose a third of what the average investor loses, just right off the bat. Now let's assume, all right, but I'm earning 4 to 5% on my T-bills, and the other part of the heat formula is always have hedges. So I've always got hedges, and those hedges are not bonds. Those hedges are different ETFs that structurally are broken that I may be short, high flying companies. And also, I'm asking AI, which again, I am dependent on AI when I see something, not only who are the winners, but who are the losers. Right. And I am short the losers. So really, worst case scenario, you get a 2008, 2009, assuming I'm not trading my portfolio, which I would be, I'm probably going to lose 10% when everyone else is losing 60. That's where so what I love about options from a risk reduction standpoint, and again, I'm not talking about the retail guy who's on Twitter, I put my whole portfolio into SPY 0 DTEs.
Yeah.
I have 60 or 70 positions. And I have what I call a unit size. So let's say, for example, my unit size is $1,000. So that means each option has $1,000 in it. That is my max risk versus, let's say I bought, Apple. What's my max risk in Apple? I don't know. It's not going to zero. So you could say, well, everything you put in, no, you're not going to lose it all. But Apple could go down 10, 20. Totally. It's already down like 10 or 15% from the highs. Right. But in an option, I know in this call option, I can lose $1,000. I can't lose more than that. And my upside is unlimited. And what I've seen in some of these names is, massive upside when you're in a Tempest AI, for example, that Nancy Pelosi buys, and it goes up 40%. You've got unlimited upside there. That's how I like to reduce risk.
So you manage risk with cash?
I manage risk with T-bills, and I manage risk using options,
right?
Where I know every position I enter, this is what I can lose, which you just don't know with a stock.
Yep, totally. So interesting. Love that. On the other front, now back to your ETFs. So you have ETFs in a lot of different spaces, whether they're thematic or whether they are long short for trading. One of the interesting things that I'd like to hear from you is you have the T-Rex series of ETFs, which are either leverage long or leverage short individual holdings. And I believe, and you can correct me if I'm wrong, you have everything from Bitcoin to Apple, Microsoft, NVIDIA, MicroStrategy, and Ether. And you can go 2x long or 2x short on each side of every one of those trades. My question to you is, that is something that is being duplicated elsewhere, or you have duplicated, depending on which one came out first. What differentiates what you guys are doing there versus every other 2x long NVIDIA ETF?
So in everything that we've done, we've been the first mover in some way, shape, or form. Okay. So like NVIDIA and Tesla, we were the first 2x. MicroStrategy, we were the first 2x. Okay. Netflix, we're the only one out there. So will I issue something that already exists? It'd be a rare instance. I mean, the team was actually kicking around a name that does already exist, but I think that we can market it better, and we may come out with that name because, I've got a following with retail investors, and my differentiator is I mean, not only will we issue the product, but I'll help you, how to trade it. I'll give you strategies on how to use this stuff. It's the same things that I'm doing.
Awesome.
And my partners on the Levered and Inverse Direct Shares guys also have a following in retail. So we may launch a name that somebody else launches, but typically what we're going to do, we're going to be the first.
I love it. And so just for clarity's sake, from a layman that's not using leverage long short products, would there be an anticipation that the performance on yours would be at all different than an existing? And I'm not saying that that's a bad thing. I'm just curious and would like to know that.
I mean, theoretically, you could have differences. Operationally, we've been doing levered and inverse since 2021.
Yeah.
You've got some new entrants into the space. I mean, people can make mistakes. There could be differences in dividend payouts.
Yep.
Things like that. I mean, we've been doing this a while. We know what we're doing.
Heck yeah.
But,
and so you talk about having a retail following. Where does that retail following, what platforms, how are you accessing the retail trader and discussing not only what you're doing yourself, but it sounds like showing that you're eating your own cooking, which is one of the most important things I think that happens. Every client we bring on board to Life Goal as wealth managers, I show my individual portfolio. And I think that's a huge differentiator. And it sounds like you're doing something similar. I'm not saying that's exactly, but where are you accessing the eyes from a retail trading perspective?
So we do a bunch of stuff. So I do a daily newsletter that I call the Heat Formula. And, primarily what we're doing in there is we're looking, these are the themes we're looking at. And I do that a lot for me because it forces me to be reading all the news stories, seeing all the stuff. And, so it's just as much for me as everyone else. And then occasionally I'll see some stupid article and I'll point it out look, and I kind of call it, news versus noise. Be look, this is noise. Don't listen to this. This, on the other hand, this was a below the radar screen article. This is actually important. You need to pay attention to this. This is going to be big. So I do that. I do, a bunch of podcasts. We do a monthly webinar. And then during the day, I'm on Twitter. And there are a couple of different Discords I'm in where, there are seasoned traders in there talking. And, from a compliance standpoint, I try not to say too much. But, occasionally, there'll be something where it's like, all right, I got to chime in here. I got to chime in here. But, I also get a lot out of it because a lot of times, these guys, there are some really smart guys on Twitter and in these Discords.
Totally.
And they're going to be on themes before I am. And, some of the best themes that I've been in, I got from people on FinTwit.
Yeah. And it's awesome just to get that sentiment. It's a sentiment vibe feel for,
what are these guys looking at?
Totally. It's funny. We do things very differently. I mean, we are not traders. We're long-term investors on the Life Goal side. You are a trader, and everything is a function of, it gets to long-term, don't get me wrong. But we try to do a lot of the same stuff. What I mean by that is no BS. You try to cut through BS in the trading world. We try to cut through BS in the macro world and then in the longer term investing world. And we put out videos every day. And to your point, I do the videos every day and they're 60 seconds to a minute and a half long on Instagram, on TikTok, et cetera. We've got 400 and something thousand followers between them, but it's just as much for me as it is for the audience. It's, hey, how do we break this down in a way that other people can understand that might be more lay people than industry experts? And that just makes, us better, you better for writing your newsletter and keeps you up to date. I mean, that's hugely important.
Oh, without a doubt. I mean, if you're not, again, things are happening so fast.
Yeah.
If you're not keeping track of the news, I mean, quantum. I didn't even know what quantum computing was 3 weeks ago. Yeah. Now I own.
Well, Jensen's making sure that no one knows what quantum is anymore anyway.
Yeah, I mean, we'll see. And again, I mean, that's something where I just feel you've got to be there. Yeah. You don't know. quantum could be 30 years away and it could be nothing. It could be 2 years away and it could be better than AI.
Yeah.
I'm not an expert.
Yeah.
I'm going to buy calls, long term on all the quantum names.
Yeah.
And if it works, I'm going to make a lot of money. And if it loses, I've got fixed risk. Not a big deal either way.
I think that Jensen's words were totally misconstrued by the market. I don't think he said quantum is not coming. He did not say quantum's not coming. He said quantum is going to be here in a big way. But I think what he did was potentially lengthen it out some. And I think that it got taken as very negatively. And I don't think that that was his intention of what he was trying to deliver the message. But
I don't think so either. And I bought that dip.
So, yeah, heck yeah. And how,
so far,
full disclosure, I don't even know. Has it worked out since that dip?
It has. I mean, those companies are all over the place. I could be getting my butt kicked today on them. But yeah, again, I've got, I think very long term. I've got long-term calls, a year, sometimes 2 years out on these things.
Yep.
I'm going to hold on to them, and we'll see what happens.
Yeah.
I don't know, which is why I own them. And they move so much, I don't trade those because and I see people on Discords like and they're smart guys. They're short those names. It's like, okay. But today it's down 30%. Tomorrow it's going to be up 60. I'm just going to hold on to my long-term calls.
Yeah, I love it. Well, you have a super interesting approach to the business. I think that you're a deal maker. You're a very tempered, disciplined person when it comes to options, where it's a game of just absolute gunslinging for a lot of people, which is why you can produce consistent returns over time. I think your skill set's amazing. I think it's very few duplicate the skill set that you have, but you also came into the industry in 91 and have honed your craft between now and then. But you're also not an old school stodgy guy who's like, hey, AI is disgusting, this and that. It's like, no, use your disposable tools to make your life easier, to improve returns over time. And it sounds like you've done that more masterfully than 99% of the folks out there. And to your credit, you're launching products in the market that have garnered $3.9 billion of flow in an industry that is incredibly crowded. So kudos to you, Matt. I just want to say thanks so much for the time today. Hearing someone with diabolically different approach to the market, but a lot of the same underpinnings of managing risk and understanding risk reward, asymmetry, et cetera.
Which is what it's all about.
Yeah.
There's different ways to get there, but you got to get there.
Yeah. Yeah. Well, you've done it masterfully, and the proof is in the pudding. So thank you so much for the time today. Appreciate the heck out of you. I hope we can do this again sometime soon. And I think the audience is going to absolutely love it.
Cool. Yeah. Thanks for having me.
Appreciate you, Matt. Talk soon.